The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady. This is the end of the tax year. We got like 3 days left. Tuesday night at midnight, the jig is up and we want to help you. So if you haven't filed, or you're having trouble, or your return's been rejected, or you're getting letters from the state of New York asking for your W-2 information, or you think you did it wrong, or you know you did it wrong, or you don't know what to do, EG Tax will help you. We have 34 area offices. We're open today until 9. Tomorrow we have 3 mall offices open to help you during mall office hours. Monday and Tuesday, we're open 8:30 in the morning until 9 o'clock at night, or till the last body leaves the office. And I got Chris Fabian in the studio with me. Hey, Chris.
Hello, Esther.
It's good to get out, isn't it?
It is. It is. You
and see the
sun
sunshine and the warm April spring.
Yes.
Not. It's. I was telling somebody I do have seasonal whatever disorder. I am sad. I'm sad. I would like to see a flower. But anyway, we got like 20 things we want to impart to you, because if you hear something that you didn't do and you think it has something to do with you, many of you can amend your tax return before Tuesday if it gets you money back and reduce your liability. And I will tell you what's closing on the 15th, which is tomorrow.
That is 2014 tax year.
And that's pretty darn important, isn't it?
It is, especially if you haven't filed and you have money coming back.
Now, if people say, I don't have to worry about filing, I got a refund. Yeah, after 3 years, when the year is closed, you lose your refund. There are parents sitting out there with kids that have been working, and they're claiming the children as their dependents, which they should do, but the kids have tax returns to file with refunds coming, and the parents haven't filed them. The other day I was doing a tax return for a parent, lovely family, and he says, you sure I don't put my son's tax return on my thing? And I mean W-2 on my tax return? I said, no. He said, well, he doesn't have to file. I looked at it, and he didn't have to file. But he wanted to file because he had $245 coming back. So then I said, well, that's 2016. What does 2017 look like? So they faxed it over. So the kid gets $500. And, I know this is repeated time and time and time again throughout Western New York. There are kids working that don't have to file a return, but they have refunds coming.
Right.
And those refunds, the 14 year is closing on the 15th.
Right. And that's, to these parents, okay, we'll put the $3,000 on your return, and let's see, at 25%, that means you're going to pay an extra $750 in taxes.
Of course, you don't put it.
But you don't. But I'm just saying, do you want to pay the extra $750, or do you want their kid to get back their $250?
Here's the bottom line: if you haven't filed in 2014, or your kids worked and you didn't do their return, take another look at it before you lose the money, because you can't get. They don't bother you, and you don't, and you can't bother them after the statute closes, which would be April the 15th of 2018. So get those returns done, right?
Yep.
All right.
Get her done.
I'm Esther Gulius, the Tax Lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. That was our first tip. File returns for kids. They have refunds coming, right?
Yep.
Let's go to the phones, and we're going to talk to Deb. Hey, Deb, how can we help you?
Yes, you just said they're due the 15th. Are the 14th due on the 17th or the 15th?
I believe that year was the 15th.
15th? Okay. And then my other question is, if I paid delinquent property taxes for 2016 and 2017, are they deductible on my Schedule A?
Yes.
The principle is what was originally due is the extra amount they're hitting you with is not.
Okay.
Okay?
All right. Thank you.
All right. Thanks, Deb.
Okay. Bye.
I'm Esther Gulius, the Tax Lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and we got Kevin from Pendleton. Hey, Kev.
Good day, Esther. Esther, you've been doing, you are an expert in this field when it comes to taxes, and there's no disreputed, challenge in that. I wanted to ask you, is there something such as a statutory or regulatory agency that overlooks companies or individuals who prepare taxes?
Oh, yeah. Well, first of all, the state of New York requires all tax preparers who are going to be paid preparers who prepare more than 10 returns, they have to be registered with the state of New York.
Mm-hmm.
So that's one regulatory agency. Then the Internal Revenue Service,
has what's called OPR, Office of Professional Responsibility,
and they oversee tax preparers as well. Many times, the IRS comes in and shops tax firms to make sure that they're not cheating. And so tax preparers can go to prison for doing bad things.
Okay, so when it comes to if there's something questionable in the way their ethics and how they do stuff, the OPR will be most appropriate.
Yeah.
Okay, it's the OPR.
Right.
Okay. I thank you so much, Esther.
You're very welcome. Bye-bye. Thanks for calling. I'm Esther Gulius, the tax lady from EG Tax. Tuesday is the deadline, Tuesday midnight. And if you haven't filed or you're in a quandary or you're getting letters or you don't know why they shorted your refund, you can always call EG Tax. Because we're very happy to help you. Our website is egtax.com, and there's Ask the Tax Lady on there.
Right on there.
Go ahead and ask your question.
Download our app, and even on our app, there's
All right,
Ask.
so, and our thing, while we're here, we're going to take a break in here in a minute, but qualified dividends and capital gains, why is that important for people?
Because that's a reduced tax rate. So 15% to 0%.
Now, I can appreciate when you're doing your own return and you look at that Schedule D because of your qualified dividends or your long-term capital gains, that it looks really confusing, and so you say, I don't want to do this. What if they don't do it, Chris? What if they don't use the alternative method of computation?
They'll pay extra tax. I just have someone from New Jersey right now I'm doing a return for. They faxed it in or whatever, and here's my dividends. And I know they're qualified dividends because I know the stocks. But if they just put in my dividends, that's $6,000 at ordinary income instead of the capital gains rate, they just lost a lot of money.
That's exactly right. The whole thing is, let's say you're in the 25% bracket, let's say you're in the 15% bracket, just make easy math, and you had $10,000 in dividends. If you tax it at the 15% bracket because you don't use the Schedule D,
right? That's $1,500.
You pay $1,500 when you should have paid
zero.
So $1,500 is a lot of money to me. So you want to make sure that if you had qualified dividends or long-term capital gains, that you use the Schedule D for the computation of your taxes on that particular amount of income because you save money, right?
Correct.
Okay. We're going to take a short break. We'll be back on the other side with your phone calls, 8030930, 8030930, star 930 on your cell phone. I'll see you in a minute. Hey, this is Esther Gulius, the tax lady. Tuesday's the big day. I'm heading out for a palm tree on Friday, God willing, and we want to help you with your taxes. 8030930, 8030930, star 930 on a cell phone, and Carol's been waiting a long time. Hi, Carol. How can we help you, my dear?
Okay, I was wondering if do you know what the 2018 standard deduction for single person age 72 is?
Well, go on.
A single person, $12,000 plus the extra amount for being over 65. You're looking $13,500.
$13,500 for 2018.
Yep.
They change it again. Okay.
Yeah, unless they change it again.
Yeah,
Yep.
Right, unless they change it. Right, which they've been doing. They've been adding and subtract. They haven't subtracted. They keep adding deductions from the time tax law was first passed. So, but we will keep you abreast. So you just keep listening to us, Carol. We'll keep you abreast on News Radio WBEN. Ask the Tax Lady. We will we'll let you know the changes as they come about. Okay?
Thank you very much.
Thank you, sweetie. Bye-bye.
And that's, I'm sure, one of our tips is, doing your tax planning. I had a client who had $25,000 in employee business expenses. And he goes, what does the new law mean to me? Well, let me tell you.
Yeah.
And it wasn't pretty.
Yeah, it's terrible. It's terrible. So I just had a client today, upper income people, but they were large itemizers. And they're losing the SALT deduction.
Yep.
They're getting cut in half. So they had a refund this year of $2,000. Their refund next year, everything being the same, was $500. So I said, well, if they're giving you more take-home pay now, that would mean that your refund, the money to pay your liability next year is going to be less. And since we know that your tax bill is going up $1,500, if they take out $1,500 less, that means that you're going to end up paying $3,000 more next year. And they go, what? Yeah, what?
Yeah.
So I said, just tell them you go and change your W-4 at work to make sure that it's good.
Yep.
Because you don't want to be, now if you want to owe next year, that's up to you, but most people don't want to owe. Let's go back to our tips here. And again, I'm Esther Gullius, the Tax Lady. Our 3 mall offices are open tomorrow.
Yes.
And they are?
They are the McKinley Mall, the Boulevard Mall, and the Fashions Outlet Mall in Niagara Falls.
That's right. And so those of you procrastinators that want to get in early, you can go to the mall offices. And again, 8030930, 8030930, star 930 on a cell phone. All right. Another tip is something to look at. If you're if you're a C corp, you may want to and probably should move to an S corp. And why would that be, Chris?
Well, because of double taxation. Because the C corp pays taxes on the net profit. So if you make $40,000, the C corp's going to pay tax on $40,000, and that rate's probably like 36%,
which is higher than normal too.
Yep. But then you go, well, that's my money. I'm the president of the company. I want it, and you take a distribution. Well, now that counts as a dividend. So if you take $30,000 out, now that $30,000 was already taxed at the highest rate for a corporation, and now they're going to get taxed again on the personal level as dividends. So you're looking at another 15%.
Yeah. So, but what if it was an S corp?
If it was an S corp, the profit just flows through to you. Yep. As long as you have a reasonable salary.
Right. And then the other thing is, let's say we're looking at that $40,000. Next year, that $40,000 will get a 20% pass-through deduction, or $8,000. So not only does the corporation only pay taxes once, but there's a pass-through deduction of $8,000. And if this was this person's only income, they would pay it at like 10%.
Yeah.
And so they would save lots and lots of money. So if you have a C corp, how hard is it to become an S corp, Chris?
It takes about 5 minutes.
Right. You just do a 2553 and a CT6, and poof, you turn into an S corporation.
Yep.
And you will save a lot of money. All right, that's another tip. Now, on the federal return, on page 1, it says state and local tax refunds. Right, that's all it's.
Line 10.
Right, line 10. It says state and local, and so I've seen people just take their refund from New York State, maybe $2,000, and put it on line 10. Is that correct?
No.
Why?
Because first of all, hurdle number 1 before you put it there is, did you itemize last year?
So if you itemized, you don't even consider the refund.
Right. If you just took your standard deduction, you don't have to put anything there.
Right.
If you did itemize, then you got to look at page 4 of New York State and see what refundable credits you had. So if your state refund was the $2,000 and you had 3 kids, that's $990 credit there. You had a $350 family credit, so that's $1,340. You
off
back
of our $2,000 refund.
So you pay tax only on $660 of that $2,000.
And that's what a lot of people don't know. So if you've been in the habit of just taking your New York State refund and taxing it on line one, you've been probably overpaying.
Yep.
Right? So wanted to let people know that. And then let's see, we want to do the... Oh, I know. If you have a kid in college, New York State has a college credit.
Yep.
Right? Should you always take the credit?
Trick question, because the credit could lead to an itemized deduction,
Right.
which could be a better result for
Right.
you.
So you would either take the credit or an itemized deduction. And if you're in a higher income bracket, the itemized deduction works better.
Yep.
So a lot of people don't know that either. The other thing is about New York State is that you were talking about refundable credits. It means that the state of New York actually gives you money that you didn't pay into the tax system, like with withholding. So, for instance, if you had a daycare, child care credit, the state of New York says a refundable child care credit.
Yep.
The Empire State, the Empire's credit for kids, that's a refundable credit.
Even if you don't have to file a return, and you have children
Right.
under 17 in your house, New York State will give you $100 per child.
Right. So right now, you're sitting home, you're on Social Security, you got two little nippers under the age of under the age of 17 at home. The state of New York will give you $200 back, refundable credit.
That's, gotta love New York.
Yeah.
I mean,
unless you're
how about
taxes.
if you're a senior and you may only have Social Security and a small pension, but you're a volunteer firefighter?
$200 credit.
$200 credit there.
Right. So all of these refundable credits are part of the refund you got, but that's why many times people say, well, why doesn't the state of New York send me out a notice that says what my refund is so that I know what to put on the line? Because they'd have to compute the credits. Now, the other thing about New York State is many times, and the federal government is doing the same thing, you'll send in your return, they send you a shorted refund.
Yep.
And they'll say, and you have to look at this notice to see why did they short your refund. What they're doing is they're putting the ball back in your court, and so you have to prove what you put on your tax return in order for them to compute the tax liability based upon, or refund based upon, what you had originally submitted. So don't just accept the shorted refund.
Right. Don't just pay it. Don't just ignore the letter. Oh, it's the government. It must be right. Because they're going to do that all the time. And it may be simple as just sending in a W-2, sending in your child's Social Security card with the birth certificate. I mean, so...
Yeah, and that's what you have to understand. If you've gotten a letter from New York State and it said, we need help processing your return, we need proof of your withholding that you've put on your tax return, if you ignore it, they will not send you the money.
Right. It's gone.
Right? I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. So, and we're talking about things that a lot of people don't even know, never think about, and so they consistently do the thing that isn't in their best interest year after year after year. And I will tell you, if you heard something that you say, gee, I really should think about that, I might have not done that correctly. 2014 is closing on 2014 is closing April the 15th of this year. Which will they give us till Monday? Because it's
Maybe.
I don't think so.
I don't know.
I wouldn't take that.
But
chance.
speaking of, I know I don't see it on our list. One of the things is, I've seen, how many people have you seen who had rental property that never took depreciation? When they're do-it-yourselfers.
That's true.
It's too complicated. I don't know what to do, so I never took it. Well, you could be losing out on a $3,000, $4,000 deduction a year, which could mean $1,000 to $1,500.
Well, because they know that when they sell it, that they'd have to recapture it. But the interesting thing in the law says you recapture it even if you haven't taken it.
Yep.
So if you haven't been taking your depreciation, that's another thing. The other thing is, and this is something that people aren't aware of, if you're a private pay patient in a nursing home, the nursing home is assessing you a bed tax, which is 6% of the amount that you're paying for the room. That constitutes a refundable credit because the 6% bed tax should not be assessed. So if you paid $10,000 a month, you have $600 a month coming back times 12 months, $7,200 on bed tax if you have a loved one that's in a private pay patient.
Yep, I just did one today. Matter of fact, $7,658 coming back from New York State.
Right, and that's a refundable credit again.
Yep.
All right. So if you've had a loved one in a nursing home and you've never applied for the refundable nursing home credit, it's IT 258. And you have to file a New York State return, the 258, in order for you to get the money back. They will pay you back the money. And you might be the executor of the estate because maybe grandma and grandpa or mom and dad passed away. That money will come back to the estate.
Yep. And, speaking of nursing homes, another thing people miss on New York State is the credit for paying for long-term care insurance.
Oh, true.
And that credit, they go, well, I didn't need it, so I didn't do it. But that carries forward year after year and builds. So maybe you sold your rental property.
Then you need it.
And then you're going to need it. And so now you have this credit.
And the other thing is the federal government has a reduction in capital gains taxability like we were talking about before. The state of New York doesn't offer that.
No.
So when you're carrying forward that nursing home credit, maybe you sell a lot of stock one year. You're really going to be glad that you have it. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. I'm going to sneak Christine in real quick. Hey, Christine, how can we help you?
Yes. On the form I have for 1040, the standard deduction is $79 for a person who it cannot be claimed as a dependent. Is that correct?
No.
You mean someone over age 65?
Yes, that is correct.
Okay, it's not $79. It's $6,300 plus the extra $1,250 for being over.
I think you're reading it wrong, Christine.
Be $7,900?
Yeah. You know what? I'm going to put you on hold. We'll talk. We have to break for the news. Hang on for a second. I'm Esther Golias, the tax lady from AG Tax. We're going to break for news. We'll see you on the other side. Hey, I'm Esther Golias, the tax lady from EG Tax. Tuesday is a big day. We got to get all of our taxes in. Tuesday midnight, you got to pay your liability. A lot of people think they can file an extension. Does that work, Chris, filing an extension?
Well, if you want to delay your paperwork, yes.
How about paying my tax? Well, isn't it true if I file an extension that I get to wait till October to pay my taxes?
Not at all.
That's right.
Nope.
Taxes are due Tuesday at midnight.
Yep.
Right? It has to be postmarked by Tuesday midnight. All the extension does is extends, like Chris says, the paperwork to submit to the IRS, substantiating your deductions and income. The other thing that it extends is your deadline to fulfill your pension contributions to like a simplified employee pension or SEP or 401 solo 401k. So that it can be used for that to delay just putting the money into your pension plan. But aside from that, those taxes are due Tuesday at midnight, federal and state.
Correct.
So the 4868 and the CT 370 would be used to delay the paperwork, but you got to get your taxes in.
You got to get her done.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and we're going to talk RMDs right now, required minimum distributions.
Yep, and what that is
required,
meaning you have to.
You got to do it. You got to take money out of your IRAs and your pensions that you've been waiting on until you reach age 70 and a half. You must start taking them out, or if it's your pension plan, that you've severed employment. Interestingly enough, I had a very good planner, lady that's been working in at one of the car places, who's got well over $1 million in her IRAs and her pension plan, and she's 80-some years old. So when her RMD is going to be almost $100,000 because she has to start doing it when she retires.
Yep.
So she's going to retire this year. So your required minimum distribution is extremely important that you do it. If you don't take out your required minimum distribution, the penalty is
50%
of the money you didn't take out.
Yep. So for her, it would be $50,000.
And that's not income. That's a tax. So you want to make sure that you're doing your RMDs. Now, with the change in the tax law, and we're going to talk a lot in the summer about the change in the tax law, but one of the ways to skin the cat is to utilize the RMD up to $100,000 to fund your charity. You will fulfill your RMD requirement, and if you're somebody that likes to give to charity, this is a way that you can guarantee the charitable deduction because it won't be income, and an RMD distribution at the same time. So, like, let's say that you have somebody that would normally give $20,000 to the Upon the Rock, right?
Okay.
And their RMD this year is $10,000. They can do a $10,000 trustee to trustee transfer. I mean, it wouldn't be trustee to trustee from your RMD to from your IRA to the church, and that would be a direct. It didn't go to you. Direct rollover, and that $10,000 would then make the RMD fulfill the requirement, and it wouldn't be taxable, and it would give the church the deduction, right?
Yep.
So that's something that you can do this summer, because many of you that have been using charity in the past, with the increased standard deduction, you're just not going to come to that threshold.
Right. But charity is still an itemized deduction.
There's still 5 itemized deduction categories: medical, taxes limited to $10,000, interest, and by the way, they've just added
home equities as long as it's used for home improvement.
Charity and gambling deduction, and if you're living in a disaster area,
federally declared. Yep.
So those things are still deductible, but many people who are just on the cusp, they won't be able to use that charity. So that charity RMD rollover is absolutely great.
Yep.
Right?
Yep. A lot of tax planning, because that could also impact their Social Security.
And that's the other thing. That's right. Because if you don't have to take the RMD, then your Social Security might not be taxable.
Right.
Right. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. What else we got? How about sales taxes? Sales taxes is an itemized deduction.
Right. So that would go in your SALT location, and where most people who use it are retirees who don't pay into New York State, so they have no state tax paid, so you can use your sales tax.
But the chart figure that they give you is 4%, because the New York State sales tax is 4%.
Yep.
However, we live in a county, or in counties that surround us, that is 8% or 8.75%. So in order to get the correct sales tax deduction, you have to actually double or more than double what the chart figure says in order for you to do it correctly.
Right. And don't forget, if you bought a new car or leased a new car, the sales tax on that is added to the chart figure.
That's exactly right. All right. Let's go to the phones, and I'm going to talk to Carol in Grand Island. Hi, Carol.
Hi, Esther. Thank you for taking my call.
Yeah.
Look, I have a question in regard to that private pay for nursing homes.
Yeah.
I'm a private pay, and they just give me a bill with the total. They don't show a bed tax. How do I know what the bed tax is?
Are you in a nursing home or an assisted living? Are you paying $4,000 a month or $11,000 a month?
Pardon?
Are you paying? How much are you paying a month, Carol?
Well, he was at 2 different ones.
Oh, okay, so it's not you. All right. So was it like $10,000 or $11,000 a month?
Pardon?
Was it like $10,000 or $11,000 a month?
Oh, no.
So he wasn't in a nursing home.
He was in assisted living.
Okay. This is strictly nursing home.
Okay, so now he's in nursing home, so starting this year.
Okay, so
Do they have to show the bed tax?
There should be an individual line that says excise tax.
right. So here's the thing. Since he is now paying at least $10,000 because he's still private pay, right, Carol?
Yes.
So you just ask them; they will provide you with the excise tax that they're charging you.
Yep.
And then when you do your tax return next year, you do the IT 258, and you'll get that money back.
IP 258.
IT.
Okay.
Okay.
Ask them about the bed tax.
Okay.
Okay.
Thanks, Carol.
Much. I just
Bye-bye.
clarified
I'm
that.
glad you called. Thank you. And that's what's so important. It's got to be nursing home.
Yep.
And the assisted living doesn't count.
Nope.
But the thing is, if it's private pay, we're not talking about a combination of partially private pay, strictly private pay, then they're charging you that excise tax, and you can get it back, right?
And don't forget, if you're an assisted living, a memory care unit, that all can possibly go as a medical deduction on your Schedule A.
Right. You just ask them, what percentage are you charging me for medical treatment?
Yep.
And then that's a large medical
That could be a
expense,
huge deduction.
right?
Yep.
All right, I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone, and we're going to go to Carol in Cheektowaga. Hi, Carol.
Judy.
Judy.
Hi. I thought you said Judy.
I said Carol, but I meant Judy. Good, great.
Answered anything.
I think it's getting towards the end of tax season. What do you think?
I think you're tired. Time to go home.
Yeah.
I had a question. I have someone that I know that lives in Canada. She's an American citizen, but she's been up there for many, many years, and she's just taken her Canadian citizenship, and she'll be dual. But her question was, in case she doesn't have it right now, but if she opens a business, she was told that she has to pay taxes both in the United States and in Canada, although she's not lived here in over 20 years.
All right. As a U.S. citizen, you're taxed on worldwide income, but you get a credit on your U.S. return for taxes paid to the other countries, any other country. So there's several things she has to be concerned with. First of all, if she is a dual status or U.S. citizen living in Canada and she's got any assets in Canada over $10,000, she's got to do an FBAR.
Correct.
Right?
Well, what?
A FBAR. It's a financial banking and reporting form that's due actually tomorrow.
Right, on the 15th.
Right. And the failure to do the FBAR can result in fines of a minimum of $10,000 for failure to file the form. It's really just an informational form, but it's extremely important that your friend do her FBAR, number one. And number two, she would have to pay taxes if she's a U.S. citizen on her Canadian income, minus the credit for foreign taxes paid to Canada.
Okay, so she'll have to have an accountant obviously figure that out because that's too confusing.
I would think so.
Yeah, so then if she inherited something like a home or a business or something, then she would have to obviously pay taxes in Canada and then therefore taxes in the U.S., but minus
the credit that she'd get for paying taxes in Canada. Here's the thing, though.
Yeah.
She obviously has assets in Canada?
Not really.
No, she doesn't have a home. She's not married?
She's married, but the home was in her husband's name.
Is the house now in her name?
Changed it to both of their names.
Okay, well, you see, she's got to do an FBAR.
Oh, shit. Sorry. Oh, my God.
Okay.
Oh, tomorrow's Sunday.
And tomorrow's Sunday. Well, hallelujah. Well, I'll do a hallelujah to cover up the other thing. Anyway, she's got to do an FBAR. You go to FinCEN. You go to the Internal Revenue Service FinCEN on the internet, and you'll see where you can fill out the
FBAR
report.
Called like you want to go once you're on the IRS's website. It's the BSA filing system or something.
But just Google FBAR, FBAR, and it'll come up. Okay.
Come up. Okay, this should be interesting. Thank you so much.
All right.
Much earlier in the year.
Thank you. Bye bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell
and I
phone.
don't want to scare her, But she should go back.
She has to go back and
at
do
least
multiple
6,
years.
do up to 6 years, and then what she wants to do is say, I want to file these under the streamlined method. This way, they won't go back and assess any penalties.
Right. The thing is, you can put an explanation when you're filling out the FBAR as to why you didn't file. And obviously, she just didn't know.
Yep.
She had no idea. For those of you that are U.S. citizens with income in Canada or Canadians with that are dual status, you have till tomorrow to get your FBARs in there, which, as a matter of fact, this afternoon, that's what I'm going to do. I have 2 FBARs to do. I was this lovely ladies that are from Canada that live in the United States now are U.S. citizens, dual status. And for the last few years, I've been saying,
you got to do it.
We got to do this. So yesterday they said, prove it to me. So then I downloaded the explanation.
Don't say prove it to Esther.
And I said, here, read it tonight. And they came in with all their documentation. So we're gonna.
And I heard through like 3 or 4 clients that they're looking to change the limits because they're tired of all the small FBARs coming in.
Yeah, they're looking for the big money.
Yep.
Right. All right, let's go back to the phones, and we're going to go to
Earl.
Earl. Is it Earl?
Yep.
Yes. Hey, Earl. Earl from Akron. Hi, Earl.
Hi, Esther. This is Earl. You know who I am. How are you?
Oh, I love you, Earl.
I love you too, Esther. God bless.
Thanks. What's new?
I had a question. After I got done doing my tax, my wife wasn't with me this time.
Right, and that's a problem.
Well, yeah.
Because she's it's not like you're not the brains, but she's really the brains, right?
God bless you. Here's my question. It's twofold. One, I want to go back to the charitable thing you were talking about earlier. But we sold our boat last year, and that normally would have come up because it was, viewed as a second home, whatever, the interest and all that. Now, I had costs that were incurred for selling the boat. Would those have been deducted?
No, because you can, if you would have sold that boat at a gain, Earl, it would have been taxable. But selling a personal asset at a loss is not deductible.
What about the cost for the brokerage and the others?
No, so let's just do simple math. Let's say you paid $100,000 for the boat,
right?
And you, with everything, paid maybe it's $110,000 without all your bells and whistles. Now you sold it for $80,000, and the broker to sell it charged you $10,000. So that'd be 80 plus 10, which is 90. 90 from 110 is a $20,000 non-deductible loss. That's it. It's not going to be listed.
Okay.
Okay.
The next question was, you were talking about charitable deductions. Is that something that the bar has been raised higher on that, or how does that work?
No, see, since a married couple's standard deduction is going to be $24,000, okay?
Right.
Till you get to $24,000, let's say that you're a modest giver. Let's say you gave 5 to charity, and your taxes and everything were 10, that's 15, and you have no medical, and maybe your mortgage is another 10, so that's 25. Okay, you'd benefit by itemizing by $1,000 because that'd be $1,000 over the standard deduction. But let's say you don't have $10,000 in mortgage interest, and you didn't give $5,000 to charity. You only gave $3,000. Well, that's going to come under the standard deduction, so you won't get any benefit for that. That's why that RMD, when you're 70 and a half, if you want to give money to the church and you're not going to take it as a deduction, it's a way of having it not be taxable, not be deductible, but fulfilling the RMD at the same time.
Yeah, well, we had given way more than that.
Right.
For the tax, but you're saying the dollar amount, the threshold is $24,000 for the standard deduction.
Right.
Okay.
Okay.
Very good.
Thanks, Earl. Bye-bye.
What's going to be interesting, and what I tell all my clients is they haven't dotted their I's and crossed their T's yet. We haven't seen the true regulations, the forms. What about, can people file separate, and then can they each grab $10,000 on the salt?
And then the other thing, we're talking about itemizing on the state, and when you can't itemize on the federal. So it really is a work in progress, and that's part of what we're going to do this summer is keep everybody abreast of what's going on.
Yep,
right?
And you can also do that by downloading our app, EG Tax Service.
We have a wonderful app, and for those of you that are wondering about keeping abreast of everything, we have bells and whistles and things to keep track of your mileage and downloading receipts and all kinds of storage facilities. You can send your return to us electronically through a little portal on the app, and there's no charge.
One of my clients was like, I'm doing Uber, and I know it keeps track when I have someone in the car, but how am I supposed to keep track when I don't have somebody in the car driving to pick them up, when I drop them off to come back? I said, just download our app. And he's like, what? And so I had him download our app. I showed him it, and he goes, this is so cool. And all he did the whole rest of the appointment was play with our app, and the wife did the tax return.
Which the wives many times do. I'm Esther Gulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we got Lee from Buffalo. Hi, Lee.
Hi, Esther. I sold my home in November of 2017. Does that have to be on my income tax?
Your personal home?
My personal home.
And are you single?
Yes.
Did you make a profit of over $250,000?
No.
Did you ever use it for business, like have an office in your home?
No, I had just a rental apartment.
Okay. All right. So you had, what was it, a 50-50 rental, Lee?
Yes.
Okay. So in essence, it's two sales. One sale for where you lived in, and the other half for the rental. So on the rental portion, that's a $47.97 that goes to a Schedule D. That must be on your return. The personal portion, not at all if you didn't depreciate your personal portion. So really, the $47.97 has to be done to recapture the depreciation on the rental.
I already had my taxes done, and they said I didn't have to show the sale of the house.
Well, it's not correct.
It was one of your offices, I'm sorry to say.
That's all right. You know what I want you to do? I want you to go back, give that office a call. They obviously didn't ask if it was ever rental, because it isn't correct, and we'll fix it and make it right.
Thank you so much.
All right, thanks, Lee. I mean, what's right is right.
That's
what's
right.
Wrong is wrong.
That's right.
Okay, so other things I want people to know about, and we only have a couple more minutes before we rush back to the office. Don't forget, these are little things that mean a lot. If you have a balance due, do the 2210 on the federal government to reduce the tax, the penalty, because if you owe more than $1,000, the IRS will assess you, and the state of New York will assess you penalties for owing them money. The 2210 can get you out of a lot of penalties. Make sure you still have till Tuesday to do your IRAs and your SEP contributions, and that can really knock a lot off of the tax bill. Use 0% credit cards to help you so that you can pay up your liability, because there's a lot of 0% 18-month credit cards. Shift your debt from a credit card that has high interest rates to the 0%, and that'll free you up to pay your tax liability.
I mean, even if you have one that gives you good points, put it on there and then pay it off in May or June when your bill comes in.
Right. And don't forget, if you have MIP, they changed the law. You can put your MIP on your itemized deduction. Debt cancellation, if you got a debt cancellation, don't assume that it's going to be taxable, because debt cancellation is not necessarily taxable if you do a form to make it not taxable. What else? You can use your home equity starting in 2018 if it's for home improvement. And watch your withholding this year, so that if they're giving you a bunch of extra money on your paycheck, make sure that you really are going to save money in 18, and that you're not going to be shooting yourself in the foot if you're getting this extra take-home pay. Hey, until next Saturday, I'm Esther Gulias, the tax lady.
You mean next tax season?
That is next tax season. With Chris Fabian. If you need the best help in the world, we stand by in our work, and we love you. EG Tax. Have a great week. Bye-bye.